Hello, everybody. Adam Picallo here, Portfolio Manager with PI Financial.
Hi, I'm Matt Anholt, Senior Manager with Virtus Group, Chartered Professional Accountants in Regina.
This is our final video of our Coffee Row Egg series, Retired Know Your Income Options. So we put together this series because we had a lot of clients that had tax and investment related questions. And in this final video, we're actually going to go over an example of a fictitious client, not real, but to give you an idea of having a corporate account to know your income options.
Perfect. So what we're going to be looking at today is often, we have situations and we have scenarios that we hear so often, and there's so much planning. If I was an employee my entire career, I've paid into a pension plan, I have my RSP, I have my TFSA. There's lots of that opportunity and lots of that information available to go about. But lots of our clients, for Adam and I, have spent their entire careers in a farming operation, and they now have their corporation, they've sold all their assets, and they now have a corporation that really, that's their nest egg, that's their retirement vehicle. So how do they then get that money out of their corporation to themselves personally to retire on? So that's really what we wanted to address today. And so what we've started with is we built a scenario of that exact thing that I just kind of described. And we're going to walk through that together and just some of the planning that can be done and some of the options and opportunities to be aware of. So what we have here is we started with Bill and Betty. Bill and Betty had a big farm operation. They were incorporated. They didn't have anybody in their family that they wanted to pass the farm on to, or a successor, if you will. So they ended up selling their entire farm operations, all the land that was in the company, all their equipment, all their inventory. They liquidated everything. And now they just have a corporation still with $5 million of after-tax cash that's sitting in there. That's their retirement nest egg now. Due to the sale, they also do have what we call, and we see this often in this scenario, is there's a capital dividend account. And what that is when they sold everything, they sold their land, which is something that we often see, and land values, as we know, have increased substantially over time. And because of that, we trigger what's called this capital gain. And half of that gets left inside, is tax paid in the corporation, and the other half can then be moved to shareholders tax-free. So Bill and Betty were left with about $500,000 in this capital dividend account. So right off the top, if they wanted, of the $5 million that they have sitting in their cash they have sitting, they can move $500,000 out to themselves personally, tax-free, right off the top. So that's always something to be aware of. And as you're planning and going through that, knowing that if there are capital gains triggered, that half of that capital gain can be moved tax-free to the shareholders. The next part of the scenario here is Betty's age 60 and Bill is age 65. So with that, there are different, between the age 60 and age 70, there's a lot of different programs that are available and lots of planning and kind of optimizing retirement through those 10 years that can be done. And that's something that Adam and I are going to touch on here. Bill and Betty, when they kind of look at it, they want about $150,000 of after-tax income. So they want $150,000 of cash to meet their life demands on a regular basis. So what we can do from a planning standpoint for them there.
Hopefully they're going to be traveling.
Hopefully lots of traveling. That's right. That's right. Bill currently has an RSP worth about $200,000, and he has put into his tax-free savings account about $50,000 of principal. And there could be some growth in that, but that's what he's contributed. For Betty, she's at RSP worth about $100,000, TFSA worth about $50,000. So together, their total retirement portfolio that they have is the $5 million in the corporation, and then the $400,000 between their RSPs and their TFSA accounts. Bill and Betty are kind of, they are still very early in their retirement, age 60 and 65. There's lots of time. So they're looking for a medium to low risk type of portfolio. So Adam now is going to walk us through just some of the planning and optimizing potential that Bill and Betty have.
So one of the most common questions that I receive from clients is, what account is the income going to come from? And what are a few things for clients to think about when withdrawing from their portfolio? So from an investment advisor standpoint, again, given this situation and our clients being the age they are, I recommend on holding off on actually taking from their RSP. And the reason is because your RSP, it can actually grow tax-free for quite some more time for them. Bob, another 6 years, Betty, another 11 more years. So in this case, with them having that 5 million in their corporate account, it makes sense to really just let the investment accounts grow as much as they can when they actually don't have to pay any tax on the gains right now. And one thing I want to touch on is a lot of times clients don't understand an RSP versus a RIF. So at age 71, you have to convert your RSP to a RIF. And all that really means is the name of the account changes. So the investments aren't sold in the account and transferred to a RIF. It's really just in the year that you turn 71, by the end of the year, you need to turn your RSP into a RIF. And now at age 71, you have to start taking a certain percentage out. And I included the chart or table there for you to look at, just to know exactly how that actually works. So you'll see each year that percentage is actually increased, because what really the government wants is that RIF to actually go to zero over time. Now, many people do try and have a return in their portfolio to exceed that minimum withdrawal. So your RIF account actually isn't going down, but eventually, you know what, that does happen over time. And that's really why it's there. Now, one thing, when you are 71, what you could do actually is have the withdrawal that you make based on your spouse's income. So in this case, if your spouse is younger, so you don't actually want to take out more from your RIF, you can actually base that withdrawal rate on your spouse's income. So that's something that oftentimes people don't know. So again, in this scenario, both Bob and Betty had the RSP, but they also had their tax-free savings account. So I recommend, in again, a case like this where there's a large sum in the corporation, to really hold off on taking money from that tax-free savings account. Now, I do want to preface that if there is, needing to supplement some income, definitely that's something I look at, because again, when you withdraw from your TFSA, you don't pay any tax when you take the money out, unlike an RSP or a RIF. So that's one thing to definitely know, is that you can take that money out and not pay any tax on it. One thing to note is that withdrawals will not impact any government benefits, so like your CPP and your OAS, and that's something that, again, thinking of, if you're in this higher income tax bracket, it might not make much of a difference, but it's still something to note. Again, any of the gains and withdrawals are tax-free. And one thing to note, again, Matt is going to touch on this a little bit more, what you could do with that capital dividend account is possibly topping up your tax-free savings account. So up until 2021, you can deposit $75,500 into your TFSA if you've never deposited it into since 2009. Now, in this case, they've put Bob and Betty $50,000 each. And so that means they can put another $25,500. So they might actually want to look at topping up that TFSA so that money can, again, keep growing tax-free.
I think the TFSA is such an awesome program. And especially like you mentioned, Adam, where with the capital dividend account, that you're not paying tax on that in the corporation. If you move that to yourself personally, put that into your TFSA, you're guaranteed that any growth on that money throughout your entire life until you withdraw it is completely tax-free. And the benefit of the tax-free savings account is it's the only tax rate that you're ever guaranteed ever. It's always going to be 0%. Future tax rates, you never know if they're going to go up or down, but your TFSA is going to be 0%. So
exactly. And that's where, the number one question that I get, and Matt's going to go into this now, is, again, how to take money out of your corporation and what that really looks like. And it's, again, you have this $5 million, you've worked your whole life, you've sold everything. now what do you do? What does your tax look like?
Exactly. And this is something that we do for clients quite often is we do some tax planning because there's a lot of numbers. And when you're in retirement, there's a lot of different sources of income, and that's what I really want to start talking about here are what other sources of income do you have personally? Because we want to optimize that. We don't need to necessarily take money from the corporation. So we only want to take it if it makes sense. So we start by looking at what other, potentially non-registered investments you have. In our scenario here, Bill and Betty didn't have any non-registered, but that is something that we do see. So, with your non-registered investments, if you need after tax, like Bill and Betty wanted 150,000 of after tax cash with your non-registered investments, are those investment income, is that being reinvested? Every time you receive a dividend, are you putting that back into your portfolio? Or when you receive a dividend, are you keeping that cash and using that as part of your 150,000? So we have to look at that as a planning. There's so many different types. There's dividends, there's interest, capital gains, foreign income. All these different types of income can impact your actual cash that you're going to use on a day-to-day basis going forward. So you have to work with your advisor in doing that planning. There could be other pensions. Maybe Bill or Betty, maybe one of them before they started farming had a job that they were putting into a pension fund. So when they retire, they are now receiving part of pension. That number is something you want to talk with your advisor on so that you can optimize that cash coming out of the corporation on a regular basis. CPP and OAS, the planning regarding that. At what point do you plan to start taking CPP? You could start taking it early. Betty could start taking it right away, or she could wait. So there's a different planning opportunities that you need to do even within CPP. Old age security, when that kicks in, there is something called the old age security clawback, is often how it's referred to. And what that means is if an individual's taxable income is over, so in 2021 here, this number is indexed, so it goes up over time with inflation. But in 2021, the magic number is $79,054. Once taxable income starts going over that old age security amount that an individual receives starts getting clawed back at 15 cents for every $1. So, if your taxable income is up around 100,000, there's a portion of your old age security that an individual has to then pay back. And then when it's readjusted each year, that number will then be reduced in future years until the taxable income comes down below that 79,000. So that's just something to be aware of in all of this planning. Something that we do a lot of planning with our clients on is trying to maximize what's the best case scenario. How do we optimize this situation for our clients? So what we did in this scenario is we made it very, very simple because you can make it very complex, but we just wanted to keep it at a high level, just to have people thinking about it to discuss with their advisors. But we created a scenario where Bill and Betty, like I said, have no other sources of income. All their retirement is coming right now from the corporation. So what we wanted to do is give them $75,000 of dividend each of cash dividends. So that means in their going from their corporate account to their personal account, we're taking exactly $75,000 out for each of them. What that means though is there's two types of dividends that we could do those as. We could do those as eligible dividends, or we can do those as other than eligible dividends. And they both have different treatments. And I'll explain, I won't go into too much detail here, but I'll explain them shortly. But as you can see, other than eligible dividends, when they're grossed up, they actually would get reported as about $86,000 of taxable income, whereas eligible dividends get reported as $103,500 of taxable income. So when I talked about that old age security being based on taxable income, those are the numbers that are going into that calculation. So in both cases here, we would be triggering some old age security clawback. But what we've done is we've assumed this couple is in the mid to high tax bracket. And so what that means is for them each, if they took it as eligible dividends, it'd be about $15,000 of taxes. If we did it as other than eligible dividends, it'd be about $26,000 of taxes paid. How do you get eligible dividends and how do you determine whether it's other than eligible dividends? A big part of that is in the corporation on that $5 million that is being invested, if eligible dividends are received in the corporation can then pay those out and turn those around to the person as eligible dividends. So for every dollar of eligible dividend received in the corporation, those can then be turned and paid out personally to the individual. On all other income, you have to pay out the dividends out of the retained earnings as other than eligible dividends. So there's some planning that can be done there as well with your advisor, just looking at what is the amount of eligible dividends that can be paid out each year. Of the 75,000, there's a mix. You could do, 20,000 of eligible if you have the room, and then the remaining 55 as other than eligible. It doesn't have to be one or the other. You can mix those amounts and optimize it. So just something to be mindful of and to discuss with your advisors. So yeah.
And that's a very important point, is kind of talking about that income and, again, determining how the client is going to get that 75,000 each. Is it going to be eligible or not eligible? And on my side of things, again, Matt is the tax expert for you to talk to. I would say I'm more on this side of, okay, how to generate that income in the portfolio now. So
for sure.
Again, on the 5 million that you sold, or that Bob and Betty sold of all their assets, that's needing about 3% return to generate that $150,000 in income, which you might be thinking, okay, well, that's not unreasonable. However, even GICs really aren't paying that on an annual basis right now. And they're not tax efficient from that eligible dividend standpoint. So that's where, again, coming even back to the title of this video, is knowing your income options. So what I want to give you a bit of a picture is not exactly what investments I use specifically to generate that income, but just give you a bit of a broad overview of how you can expect to receive that income. So one thing that I go over with clients is, are you needing that income monthly? You most likely are. Is it even quarterly or semi-annually? Or do you just want $75,000 into your bank account once a year? So this is a bit of a snapshot of, on each month, what types of income and investments you can actually expect. So on the left-hand side, you can see there's different security categories. So this would be your fixed income. That could be, your GICs, your corporate bonds. Trust units could be things such as real estate investments. Equities, so that's considered stocks. So your Royal Bank, your Nutrien shares, they most likely will pay you on a quarterly basis. And then there's exchange traded funds, so very low cost types of investments, which many of them that I use actually pay clients monthly. And in my opinion, that's a very important point to make, because I do like to have that monthly income always getting paid for your investments. So that 3% that you want to take out, maybe you're not really eating into your principal all that much. And even though there maybe wasn't anybody that was going to take over your farm, maybe you have somebody that you want to still be giving money to and doing more estate planning. And that's something I help clients with. So again, having that picture of, how your investments are paying you, I find is a very powerful way to show clients that, you can do what you like to do. You can go to Florida for the winters, hopefully COVID pending, and you can take that cruise, you can buy that car or truck that you need. So again, generating income from your corporate account, Matt and I worked for clients to do that in the most tax efficient way, and explain it in a way like this to just give clients a better sense of their financial stability.
Yeah, that's such a great summary of it all, Adam. It's just knowing what you want and knowing what the opportunities are, and we can help you get there, and we can do that planning to do that in the most optimal way possible. So thank you so much for watching this video today. If you have any questions, we started with, everything's at a very high level, but if you have any questions that we addressed that you want to talk about on your personal level, feel free to contact Adam or I, and we would be more than happy to help you out.
Thank you very much.